Everyone. My name is Adel Korkor, and I'm the founder and the CEO of the AB Korkor Foundation for Mental Health. It's so good to have you with us again today. The topic is really timely. It's that of taking anxiety and stress out of preparing your taxes. And this is part of our series of webinars that we're putting together to help you address the stress and the challenges that you might face at a variety of different levels of life experiences. You know, many of you have seen some of our previous webinars, which I would love for you to see. You can see those webinars by going onto our website at abkf.org. Again, welcome. We're fortunate to have two very experienced tax accountants with us, Julie Acker and Karen Behl. They own a small accounting firm here in Wisconsin, and they service over 800 individuals and 300 corporations. They will talk to us about preparing your taxes, being ready for it, and all the challenges and the changes that have happened in the past year. Well, Julie and Karen, welcome.
Adel, nice to see you, and thank you for all of us for joining us today.
Right. I really have to admit that your accounting firm has been the tax and accounting firm that have handled my practice and currently the foundation. And Julie, you serve on our foundation board as a treasurer.
Correct.
So thank you so much for doing that, and thanks for all your work. And I look forward to the presentation by both of you. So thank you very much.
Thank you.
I'll jump right into it.
Over the years, we have noticed many changes in the tax system, and it's contributed to so much of the anxiety that we have seen in clients that we've spoken with on the phones, people who have come into the office, and just around filing tax returns. Tax season, it comes every year. It's here at this time again. And we just wanted to give you some tips and some information on how to make it less stressful, how to take the anxiety out of filing. One of the things we always say is be truthful. Report your income. Don't deflate your deduction, or don't inflate your deductions.
And we also know that there's a lot of stigma out there around the doom and gloom of the IRS, and that really doesn't exist to the extent that I think it's perceived out in the world. If you aren't misfiling your taxes, or if you're being truthful, like the last point, there's not really a big cause for concern from the IRS or the state.
And we say start early. Documents start coming to you in the middle of January. Take your documents, put them together. Don't procrastinate. Don't look at them and say, oh, I don't even want to open that envelope. That causes stress because it becomes almost an unknown. And so you don't even know what you're looking for or what you're looking at.
And try to know your limits. If you're watching those documents as they come in and you see a form that you don't even know what it is, you know, maybe you need to know that it's okay, and you may need to ask for help, whether that's from the place that gave you that form, or maybe you need to reach out to someone in our field for some additional assistance.
And that goes back to starting early. If you start earlier, it's easier to have access to a tax advisor as you run into questions or concerns as you're doing the tax return. Once we get into March, it's harder for us to accept a new client because we've got all of the clients that were coming in we planned for. If we know that we have additional, we can look at adding help or doing something so we are prepared to be able to help you.
No, that money is stressful. I mean, it's more personal than things that you talk about with your friends on other topics. Preparedness is the solution. and being open with maybe your spouse or someone assisting with your return is going to help make it less stressful and more transparent.
And oftentimes, one or the other spouse is the one that handles the tax returns. We see a lot of times where only one of them knows the entire tax position. And I think it's really, really important that both are involved in the tax picture so that you both understand it and it makes you more comfortable.
Now we're going to talk a little bit about how to actually prepare for the tax filing. Like she mentioned on the last slide, be organized and gather your documents in one place. It helps a lot if you can pull out a checklist from the prior year, even if you have a copy of all of your documents that you used. That's probably the most helpful thing, because you can essentially match each item up that you have from last year, and then you'll know you have all of your documents.
And filing early, like we were saying before about not procrastinating and starting the return, it gives you a picture of if you are getting a refund, you get your refund earlier, or if you do end up owing, it gives you time to plan and time to prepare for if you can't pay them right away, to set up a payment plan with the IRS. There are other options, but the sooner you start that, the better off you are.
And then maintaining organized records year over year. The IRS is not known for their timeliness of sending out notices and letters. So it's always advisable to keep copies of your prior year return, as well as all the documents used, and keeping that for years, not just the couple months after the filing. Because most likely if you receive a letter, it's going to be a year and a half after you're actually filing.
And then always remember to keep your address updated. We've seen many times where a person will work a job and then they move and they don't tell their former employer that they have moved, therefore they don't receive the document. And that goes for any agency that you receive tax documents for. You want to make sure if you don't have your mail forwarding on, that you've given them updated addresses, or if that time has expired, you go back again to that prior year checklist, look and see what documents you've received, and maybe you need to make phone calls to be sure you do have received all the documents that go with this year's return.
Always plan ahead. Know which method you are going to use to file your return. There's a lot of options out there, starting with paid software providers. You have TurboTax, H&R Block software, as well as you can physically go to those, an H&R Block location that would be a paid tax preparer. We ourselves are CPAs. There's also attorneys who do filing of returns. And then there's something called an enrolled agent, which are people who have taken at least some classes so that they're qualified to file on your behalf.
And the other good place to go is if you want to do it on your own. There is several free file software companies out there, and the ones that you want to use are the ones that are on the IRS's website. Many of those are for specified income limits, and you have to go through the qualifications, but we've provided the link here to go out to the IRS's website to help pick one if in fact you're looking at a free file software. Many of those free file softwares will walk you through questions, and sometimes you get into those questions and realize that you need help. And just again, I go back to the earlier you start this process, the better off you are, because if you do get through these questions and you need help, you have some other options to get your tax return filed.
And that leads right into our next slide here. If you're worried about filing them yourself, like using any of the softwares or even the paid ones, that's okay. You are not alone. Everyone stresses about different things, and we always joke here that you may not know what you're doing on your taxes, but we certainly couldn't do your job, whatever that is. We could not run a restaurant. We could not cut people's hair. We could not do your dentistry work. We always make sure people know that we can't all be experts at everything.
And know your, back to the previous point, know your limits. Know that it's okay to ask for help. It's why there are so many different options in the world for everything. And every tax provider, every CPA, we're different. And it's important that you look for someone that matches with your needs and what you're looking for. I always smile. That's why there's so many different cars out there, because everyone likes something different or needs something different depending on what they're doing. So know that if you meet with someone, you don't have to use that first CPA you meet with. It's okay. Maybe you need to go meet with a different one, and don't be afraid to have a couple interviews with CPAs as you're picking someone.
Make sure that you click with them and you're comfortable with their personality and their ability to handle your stuff without an issue. That being said, laws have definitely changed year over year, and especially in this last year, but just like the tax laws, your personal situation has probably evolved. And so while you may have started off with one W-2 and one little interest statement, you may not qualify for the simplest of tax preparing. You may now have investments and need some help to make sure that those transactions are reported properly, or even have started a small business, in which case you need to have your tax preparation solution grow with you.
Which leads us into the next slide, reviewing your withholding. As your situation has changed, as your tax position evolves, you need to really look at your withholding to be sure that the forms are filled out correctly. The W-4 is a form that everyone fills out when they start their job, but oftentimes no one updates it again. And that can cause people to either be over withheld or under withheld. So it's just something to really look at. And that will also give you a little more comfort during the year that you know you've got your withholding where it should be.
And along those lines, if you end up owing on a return, it may not be the end of the world, but you should also take action at the point at which you realize that you owe to update something or make a change with what you're doing in the current year, so that you don't have a second surprise like that if it isn't in fact a surprise. There are extensions available past the April 15th deadline. However, it doesn't mean that you don't have to pay. Everyone is always surprised that you can extend things. Well, yes, but the IRS fully expects that you pay your liability by the due date. And you have time to work out the details of that, but largely that means you have to have a substantial part of your tax return done. So we run into that a lot, where people are looking for an extension late in the filing season, but the reality is we have to do most of the return in order to find out what that number is.
And so extending just because you owe is an option, but it still doesn't stop that payment. And as I think I mentioned before too, the IRS does have options for a payment plan. And I will say that a failure to file a return is worse than not paying. We'll get into some of the other situations, but you want to make sure that you at least file the return, because as we get into the IRS letter section of this, the IRS will come and find you, and that made it worse. If you at least filed a return, they are there to work with you, and they will try to come up with a plan that a payment plan that will help get you out of the situation.
All right, so now we're going to talk about a few things that could go wrong, like not filing, and how you can fix them or be aware of what to do when you receive these notices or letters or have these situations happen to you. The first one is a more recent development with both the federal and the state agencies. They're both getting smarter with their filing, and now when they see a big change, and sometimes they're doing it randomly, they'll send out a notice before they send out the refund to verify your identity. This is protecting your refund, although it's an extra step for you. It's keeping people who are filing fraudulent returns from collecting your refund.
And it will be a letter, or the state of Wisconsin has a website you can go to do that identity verification, and they're questions that you can answer. Oftentimes they're just about the return and making sure that it is you. And that leads right into the next one with rejected filings. Why there would be rejected filings, most common is that someone has already filed a return using your social security number, your spouse's social security number, or one of your dependents' social security numbers. And the way that the system works, you are only allowed to file one return per social security number. And that is so that identity theft, which is the next item, it can be caught at the filing level. This wasn't always the case, and the IRS started to evolve their system to help protect, again, your refund and your tax account so that it is got a properly filed tax return with it.
And well, sometimes that means it's identity theft. If something gets rejected, it doesn't always mean that. Sometimes we've seen where a tax preparer doesn't enter the social security number correctly because you've moved locations, or say someone's doing it themselves and mistypes their new child's social security number. Well, that could be, you could be on the other side of that filing yours, and now they've used your number. So it's not always a malicious situation, and it's just very important that you take steps to correct it. People like us can help you with that, but usually it entails mailing a paper copy of your return, and it usually leads to a longer wait time for that refund if you do have one. So just a lot to be aware about in that situation.
The IRS has started to give PIN numbers to everyone. In the beginning, when they started the PIN number program several years ago, the PIN numbers were only sent to filing people who had an actual case of identity theft. In the recent years, people have asked for having a PIN number so that they know that when they file their tax return, they have a PIN number that matches to them, and the IRS will not accept a return without that PIN number. This has been the case. They may not have been a victim of identity theft at the IRS level. It could have been a credit card, any other kind of situation. And that PIN number just gives a second check for the IRS so they know that it's you.
Anyone can now request that. So they have a link on the IRS website for you to be able to do that. At the end here, we've got the links to their websites if you need them. The next item on the list is missed filings. So as Julie mentioned earlier, if you were to not file a return, you might get a notice of non-filing along with a penalty. Typically, we've seen that it is more beneficial for you to actually file your return at that point, even if you have the option just to pay the penalty. It's typically in your favor to file.
And the IRS, if you do not have that filing in, and this comes into the next slide also, the IRS letters will come out. The IRS gets most of your information from the other businesses that have paid you, whether that's your W-2 job, whether that's an investment account, whether that is you're self-employed and you receive a 1099 for that income. Filings, IRS letters come out for income that doesn't match what the IRS records have. Whether that be one or all of the forms have not been reported.
I would say our most common one, most common reason for someone to receive an IRS letter is not reporting stock transactions. I think that's probably our most frequent one. So a lot of times people don't even know that this has happened because it's in an investment account that someone else manages for you. It's still your responsibility, even if it is your investment advisor who's handling these transactions, they still need to be reported on your return.
And one of the things the IRS did several years back also was to have the investment company reporting your cost basis on stock sales. This definitely has helped, but there still are some that are grandfathered in, and the basis does not have to be reported to the IRS. And the only way the IRS gets that information is by you putting it on your tax return.
And some of the other reasons would be, you would get a notice, would be a small business where you're reporting a very high level of expenses relative to the income. Obviously, the IRS doesn't like to see losses year over year on a business, or a Schedule C as we call it, because that means, do you really have business purpose? Are you making money at that, or are you just using that as a way to reduce your taxable income? That's something that they will look at. So with the Schedule A, that would be your itemized deductions. The IRS is looking at various algorithms and analysis of all the electronic filed returns in order to determine if you have more charitables than you could truly afford, or possibly more mortgage interest, property taxes, those kinds of things, your expenses. If those are too high relative to your income, they may flag your return for review. And getting a letter like this doesn't necessarily mean that they're auditing you. It may just be that the system has flagged your return for additional verification. The important thing here is, again, not to overinflate your deductions, and make sure to save all of your charitable donation receipts. The IRS does require you to have those, especially, you want to make sure you've got that for a substantial contribution.
There are certain situations where you actually have to have a valuation for that charitable contribution. And so as you go to file, you would try to put a dollar amount in, and it's anything over $5,000 has to be actually valued. So yeah, if it's not cash, any kind of a non-cash donation.
And that is a place where we see the IRS looking at things a lot, because if you're donating a substantial amount of furniture or things like that, you have to put a realistic value on that. And there are guidelines out there for those types of items.
So the most important thing we can tell you is, if you receive an IRS notice, you have to respond. Not responding is going to result in the IRS just basically creating their estimate and going with whatever they feel is correct. But not always is the IRS correct. They have calculated the tax liability based on the information that they have. We have a self-reporting tax system, so there are pieces that you have to report to them. They receive much of the income side of it, and not, one of the ones Karen's mentioned before is stock basis. They do not receive all of the stock sale basis, so you have to report that to them, or they will assume that it is fully taxable.
Yes, for example, if you sold $10,000 of stock, they're just seeing $10,000, that you got $10,000. They don't know that you paid $9,500 for that piece of stock. It can really lead to some very out of line calculations on their part. And they do try to give you an estimate of what the cost would be, but it definitely is not always right. The next item is talking about HSA forms as well. We have some issues where people maybe close down the account and they've liquidated everything, and if you don't report that and the expenses along with it, they assume that you just cashed out your HSA account, your health savings account. So you always want to make sure to report both sides of any transaction.
And we definitely recommend that you go back to the tax return that you prepared, whether that was in a tax software or a tax preparer if you had someone do the return with you, so that you can set up an amended return. One of the things about this is that the IRS will have corrected it. However, the state of Wisconsin may not have seen it, or your state may not have seen it at the time. And you are still required to file an amended return then with your proper filing state to be sure that both returns are correct, both your Fed and your state. So the amended return will make sure that you're calculated the liability correct, but you will need it to file with the state also.
Yes, and we do know that the software companies do have the option for you yourself to prepare an amended return. Sometimes that may not always be advisable. That may be a time when you want to ask for some assistance, depending on how substantial of an adjustment the IRS has made to your return. But it's definitely something that you can do yourself.
The other most important thing is IRS tax scams are they're high right now. Many people are receiving phone calls, they're receiving voicemails from people pretending to be from the IRS, asking for money, asking for payments. We have seen where a client will receive a letter and then receive one of those phone calls and say, the IRS just called me about that letter. The IRS did not call you about the letter. It is very uncommon for the IRS to ever call, nor will they ever threaten that they're bringing in the local police or that you will be arrested for not paying. If you do receive one of these phone calls, there is a place on the website, on the IRS's website. You can see the link is there in the slides for consumer alerts of what kind of tax scams are currently happening, and a place for you to report them. There is also another one out there with your Social Security number being shut down that we have heard many of. Again, that is a scam. You don't want to give any of your personal information to any of the people that call you. No credit card numbers, no money, don't go to the bank.
So the IRS is not going to call you directly without you first giving them your phone number. The IRS correspondence always starts with a letter. And like we've been saying, as long as you correspond with them, and they are not going to take collection action without you receiving multiple letters. Again, via snail mail. They are not going to fax you or email you anything. Don't click on any IRS attachments. We have not seen or heard of them actually doing that. And we correspond with them on a very regular basis.
The way that the IRS handles non-responsiveness is they will send out a tax levy, and they will actually levy your account. That's the way that they handle that. So we know that giving them a credit card over the phone or any of these other options, it's just not real.
Now going back, we didn't mention this on the identity theft side of things, but this next one talks about the local police. The IRS is not going to involve the local police to bring you in or anyone, again, without contacting you multiple times, and multiple times through real channels. But I want to skip back to the identity theft side of things too. You can report if you know you've been, I know that's jumping a little bit, but if you've been a victim of identity theft, you can report it to your local police. And I just saw that in here, and I think that's something we need to mention too.
And that leads us into the 2020-2021 tax updates. One of the big topics this year is the stimulus money. It is not taxable. However, it is a reconciliation on your 2020 tax return to be sure that you receive the funds you were supposed to receive. You do not have to pay back funds if you receive them based on your 19 return, and you do not, but you do get them if you file your 2020 return, your income has come down, and you should have received them. There were also situations where taxpayers should have received a direct deposit and that bounced back due to bad account numbers. We just want to make sure everyone knows that you should make sure you report this and it is available to you.
And it includes the January deposit, even though it's 2021, it's still being reconciled on the 2020 return. I think that's confusing a few people as well. The next item on the list is unemployment benefits. They are taxable. A lot of people have some confusion about that, and we want to make sure that people are reporting that.
Including that federal additional amount that was received, that is also taxable. It will be on your 1099-G And one other thing I want to mention is we have heard of unemployment fraud where people have received 1099s showing unemployment received for another state. You do need to contact the state that you received the 1099 for and explain that you did not receive unemployment benefits from them.
With the pandemic going on, there's been a lot of people that are, say, working from home or working from an alternate location, which has led to a lot of people having income in a different state than they usually have. So it depends if you notified your employer to start taking different state withholdings or not. But it's definitely something you need to watch for, because we are seeing that happens with a lot of bigger companies.
And on that note, for 2020, there is no home office deduction for employees working from home.
With the pandemic, there was a 401k hardship withdrawal that was in place. So it is something to be aware of. Also, charitable contributions for 2020, there was a new above the line deduction of $300. For 2021, that still is in place. It will be $300 or $600 for married filing joint. Also, virtual currency reporting is something that the IRS is really starting to watch. There is now a verification checkbox on the front page of your tax return where you need to confirm that you have or have not done any virtual currency, i.e. Bitcoins. And if you have been, you need to report that. Part of the law also changed medical and dental expense deduction to 7.5% of adjusted gross income going forward.
Some additional updates would be to the contribution limits for individual retirement accounts, also known as IRAs. You can contribute up to $6,000 for both the Roth and the traditional, with people over 50 being able to contribute an additional $1,000. Again, this correlates with your tax filing and is another reason why we encourage you to always start early, because if you're going to make one of these contributions, it needs to be done before the filing deadline. That's the April 15th deadline. And the other thing is, in order to qualify, you need to be within the income range. Again, those can be found on the IRS website, but it's something you need to check before you're making a contribution. And the next thing has to do with health savings accounts, HSAs. It's something that if you have the right kind of health insurance plan, you can contribute some money to this and save yourself the tax dollars on those contributions. But it's something that you absolutely need to qualify for based on your plan. And the limits are here, the $3,550 for single and $7,100 for family. And they bump those up each year, and those indexes can be found on the IRS website as well. The last one on this slide is about required minimum distributions, or RMDs. These would be coming from IRA accounts or retirement accounts. And the IRS came out and said, basically, you don't need to take this in 2020 if you don't want to. They used to require them, but they're taking 1 year off because of the pandemic. They don't want you to have to take a substantial amount of your account out in a year that the market is down so much.
And on the next slide, just some additional items, credits, things to be aware of. The education credits, if you are going to college or you have dependents who are in college, there are education credits available. Energy credits, those range from improvements to your home, furnaces, air conditioning, fan, but also there are vehicle energy credits that are in existence, but you have to look at that electric vehicle to know that it is qualified for it. Something that your employer could have done was a payroll tax deferral. Many employers did not take part of it, but there are some out there where they deferred part of your payroll taxes and they're on a payment plan right now. For our small business and self-employed, there was the payroll protection plan, which was a loan, a forgivable loan from the Small Business Association. For 2021, you will have your same tax rates, although the income brackets will be adjusted, which is very normal. Same thing for the standard deduction. It is increased for 2021, but it goes up a little bit each year. Something to watch for, capital gains tax rates. It is a conversation that is being had right now and could potentially be a change. And last but not least is the annual gift exclusion. For both 20 and 21, it's $15,000, which means that you can give a gift up to $15,000 and you do not have to file a gift tax return for that.
And the last thing here is we're providing you the link to the IRS website, and we put on the Wisconsin Department of Revenue because that, you know, we're in Wisconsin and that's our typical state that we're contacting. Their websites are a wealth of knowledge if you are attempting to file yourself and running into problems. The agencies, both the Fed and the states, have been very helpful if we have questions on presentation of income or expense items on more complex returns. So know that they have resources available to you as well.
Thank you very much. That was amazing. That was very well organized, and I mean, for me, it was still very informative, and I learned a lot from it as well.
Thank you for having
You know,
us.
yeah, you're welcome. Thank you. You know, I have a few questions for you. What is the income limit for having to file income tax every year?
It depends on the situation, unfortunately.
So the standard deduction is $12,000 mostly. And so when you get into that situation, you have to file tax return if you have earned income over $1,500.
So that would be
I have
like
to check that.
W-2 wages. Yeah, because it's different depending on if you're a dependent or not. And yeah, we'll look into that for you.
You want, I can pull it so I can get you actual numbers, Adel, but it's not an actual number. It's not just like
It's
Yeah.
And it depends what forms you have.
and it depends if you had withholding. So you may not have a requirement to file, but the Fed may have withheld, or your employer may have withheld, and you're filing just to get your refund.
Okay. Well,
Loaded
Right.
question. Really good question.
yeah. You know, I guess I wanted to know if you only make $15,000 a year, do you really have to do you need to have to file income tax?
Yeah.
We do.
You might.
Okay. Well, the other thing about is expenses. I remember the days when I saved every bit of receipt and I had shoe boxes. That was what the purpose. And I remember I had them all labeled, you know, 2000, you know, in the year 87, 88, whatever. They were all in shoe boxes, and I would put all the receipts in there. But now we are in a different world. We're living in a world where we have digital information, emails, faxes, and stuff like that. How much of that type of delivering the information in your income tax is acceptable? The scanned documents, the files based on you know, your credit card statements that are scanned or somehow delivered digitally. You know, how much of that is permissible in the IRS?
So when we prepare a return, we always want to see the backup. If your return would get audited, you would need to provide the documentation to the IRS. Typically, we are either paper mailing that response in or actually faxing it. So it would have to be converted to a paper copy of whatever digital receipt you would have. So they don't accept things electronically except via the actual tax software.
And for the other question on receipts, even if it's on your credit card statement, if you go and you have a business meeting and there's a meal involved, you actually have to show that receipt, anything over $75, to be able to prove that that was what was purchased, that it was a meal at that place, including the documentation showing who was at the meal for the business purpose. So they do not you still need all of that documentation. Can it be electronic? Yes. Our office is about 95% paperless. All documents that come in, we scan them, but you still have to have the ability to print them to give them to someone if there were a question on that expense.
And for example, we always give to our business owners, we always give the example of a Walmart or a Target. How do you prove to the IRS that this was truly supplies for your business and not just a pair of shorts and a t-shirt because you were painting that day or something? And what would be the business purpose behind that expense?
I'm going to ask you a very touchy question, and I know it is also probably one of the things that you probably don't hear it very much from your clients, but maybe you do. What should one expect to spend on preparing their taxes, and how much money they can save by being fully prepared? If they're not prepared and don't have all the documents, is that going to cost them more?
So every preparer is very different. In our experience, very different. For our starting point for an itemized return or for any return starting is around $450, and that's if it comes in an organized fashion and is a fairly basic return. All of our billings are done on a time basis, so the more times we have to call you or contact you for additional information, that's going to increase the bill.
And as you're looking at the complexity of the return, is there a self-employed business involved in there? Stock sales, that's another one. Where is the cost basis provided? Do we have the ability to get that cost basis? To Karen's point, it's all time-based for us, just how much time we spend on it. So yes, an organized return will save you money simply because we're not doing that piece of the work for you.
The research, yeah. And we do know that some of the other agents, or not agents, the other filing companies sometimes are charging on a per form basis, or based on your refund rather than your actual time to prepare. So there's definitely no one answer for that across all preparers.
Right. You go to the discount tax preparers like H&R Block and others. Do you tend to save money going to more of the discount brokers out there?
It's quite surprising that not necessarily, because their pricing structure is going to be different. They may charge per form and based on your refund, which could end up costing you more than, say, our prep fee.
Correct. I agree.
Mm-hmm. And do you often have customers asking you, can I defer paying for preparing my taxes with my tax return refund?
That's a refund anticipation loan.
Right.
We do not offer that as a service, but there are some preparing services that do offer that. We do not, but we allow people to pay obviously with a regular credit card in order to cover that until they receive their refund.
Correct.
Cool. Well, thank you. One question I have about virtual currency. I know that it probably won't be very long before virtual currency becomes very standard in the form of financial transactions. As you know, PayPal and MasterCard and even Apple, I can't remember if Apple or not, but even some other payment services are accepting Bitcoin and other virtual currency. How do you, when you talk about reporting it, does that mean reporting it upon purchasing the Bitcoin in your account? And then when you're actually using it, maybe you're using it at a higher valuation than what you purchase it at? Where does the IRS, what are the IRS is really looking with that Bitcoin transaction?
The IRS is really looking to capture any part of that they're entitled to. So basically they're looking at it, are you holding it as an investment or did you receive it as compensation for services? Those are two very different very different transactions in their mind. If you're holding it as an investment and then you sell it at a higher price, they would like you to pay that capital gains tax on the gain of the sale of that Bitcoin or when you get rid of it. If you're a business owner who receives Bitcoin as compensation, that's going to be treated as self-employed income and needs to be included in your income on your Schedule C.
Well, I think the question that I asked is that, let's say I bought Bitcoin today at $20,000 a Bitcoin, and now it's worth 40,000, and I used it to purchase a pair of shoes at Nike, or I used it to pay for some other. When I spend that Bitcoin at a higher price than when I actually paid for it, am I responsible for the difference between what I paid for it and the value of what I used to spend?
Yes. So that the point at which you get rid of the Bitcoin, if it was a higher value at that point, that's when you're essentially realizing the gain.
Okay.
So yes, the 20,000 in that example, that was your gain portion. That would be recognizable in the year you spend it.
All right. Is your office set up to accept Bitcoin as a compensation
No, they are
for your
not.
services? Okay. Well, how soon that will happen?
Not anytime in the near future due to the reporting difficulties of Bitcoin. We have noticed that as of right now, the cost basis information is fairly difficult to get from some of these interfaces that people have been using. And the IRS is pushing for a higher reporting requirement from any platforms that are trading it.
I have an easier question for you. About the HSA, and I know that many people are taking advantage of that. I'm assuming that it has to be spent on the annual basis. What if it was not spent? Can you carry it over to the next year and the next?
That's specific to HSA, not to be confused with FSA or HRA.
And what's the difference?
An HRA is a health reimbursement account run by your employer. The HSA is a savings account that belongs to you, which you retain for until you spend it on medical.
Okay. Well, I think what we need to do is maybe have another session with you to talk about the estate planning and the tax associated with that, and all of the other topics that are, I'm sure it's on the mind of many of our listeners. Well, I want to thank you, Karen and Julie, for this presentation, and I want to thank you for your time and having put together this very informative. And I look forward seeing you and sharing with you more of this conversations in the future. So thank you so much.
Thank you.
Thanks for having us.
You're very welcome. Thank you. Well, I hope that you've enjoyed this webinar today. I certainly have, and learned quite a bit from it. I'm hopeful that you find it useful and helpful to reduce the stress associated with preparing your taxes. Well, you're welcome to join us on other previous webinars. You can go on abkf.org and go to webinars, and you can watch many of our informative webinars that we've been putting together over the past year. I want to thank all of you for joining me today. I also want to remind you that we could always use your help and your support as we're continuing to work on our mission to make the world a better place for adults and children with ill mental health. To find out how you can do that, you can go again on our website at abkf.org and click on that donate button to help us. Thank you so much, and I hope you have a wonderful day and a wonderful year. Thank you so much.